any excitement? Let's ask Michelle Girard, senior economist at RBS Greenwich, and Rafael Resendes. He is co-founder of the Applied Finance Group. Good to see you both. Michelle,
good afternoon.
First to you. Liz and I were both watching different indices. She was watching the Dow. I was watching gold, which of course went in various directions. But gold, for me, had the biggest bang for the buck after the Fed's decision. That indicates to me that folks are worried about inflation.
Well, yes, but, you know, contrary to that, if you looked at, like, 10-year Treasury yields, they dropped about 50 basis points on this announcement. Obviously very happy that the Fed is going to be in buying. So we have seen interest rates come down, which to some extent, I guess, means that the concerns about inflation were overwhelmed by the fact that the Fed is going to be in buying. So we've definitely seen interest rates move lower in the credit markets. There has been a very positive response.
Rafael, were you surprised by the response in, for example, mortgage rates? They dropped dramatically, too. And usually when the Fed moves, it takes a while to see any kind of meaningful move.
Yeah, I think we have a market that's been so hungry for good news and for some sort of action that can signify confidence that some of these banks will have the ability to refinance and start to book profits for themselves. The move that the Fed did today is pretty unprecedented in scale. So it's a dramatic shift from where we've been.
Well, Rafael, everything is unprecedented in scale over the past 6 months. And I just want to ask, you know, when you combine the Fed's moves to print so much more money in order to try to stimulate the economy with the Treasury's moves to spend trillions of dollars on its own, what kind of future does that indicate from your perspective?
You know, I think in the short run, obviously, you're trying to put out the fire in the house. In the long run, the question is, are you weakening the foundation so much it collapses later? Because certainly with the amount of money we've been dumping into the economy, and we've had relatively low monetary velocity, when that starts to pick up and activity picks up, I think we're going to be in uncharted waters in terms of where we're going with inflation later. But clearly that's on the back burner in the short run.
You see, Michelle, that's what people who are watching this are wondering. As quickly as we saw the downturn really seize the markets by the throat, could we not see an equally quick and dramatic turnaround?
Well, I think that that's one of the things that people are watchful of, both in terms of maybe the economic rebound will ultimately be better than we think if all of this stimulus catches hold. But, of course, what does that mean for inflation? And the Fed may indeed have its work cut out for it. Now, up until now, a lot of the programs that the Fed has undertaken in terms of providing money are things that will reverse on their own as the economy improves and the need to borrow from the Fed is reduced. But when they're buying treasuries and they're buying mortgage securities and agency debt, these things are going to be on the balance sheet, and they're not going to be able to be unwound as quickly. So the Fed is going to have its work cut out for it. But again, I sort of think, sort of like Rafael said, that that's a battle that is just not in the forefront right now. The first thing is to just get through this period so we actually are able to fight that battle when it does appear.
Well, Rafael, your friends at the University of Chicago, I know you went there for graduate school. I know a lot of folks there who are just, if they're alive, they're rolling over. If they're dead, they're rolling over in their grave about what's been done. But be that as it may, we have tremendous faith in the market. The market it's amazing how much resilience, no matter how bad policy prescriptions are, for the market to turn around. Could it be that the plus cycle is so inevitable that it could push through all this bad public policy?
You know, I think in the short run, it certainly can. The concern is not just inflation longer term, but also the effects of increasing taxes in terms of cost of capital for companies. As you increase taxes, companies have to generate a higher rate of return, which makes finding projects that result in such higher rates of return harder. And that's what leads to a slowdown in investment when you increase taxes. So in the short run, you know, we don't see taxes going up immediately. We see a lot of money coming in, which is going to allow banks to start to make money with refinancings and playing the yield curve game, which I think is strong for the market now. The question is, as some of this gets absorbed and we start to look out longer, I think it's a little bit troubling in terms of where some of these actions might lead.
Yeah, but Michelle, today we've got rumors that IBM might buy Sun Microsystems and Oracle actually announcing a dividend of a nickel, granted small, but hey, we'll take it. Well, when everybody else is cutting dividends, there are signs of, well, I guess Ben Bernanke called them green shoots coming up.
There are, and I think even the fact that we've had some better news on the consumer lately. I mean, just the fact that things look more stable than constantly disappointing with sales numbers. But I think that you're right, and what Rafael was saying is true. I mean, right now, the fact that the government is having having to take up and suck up so much of the money in the economy, it isn't so much of a problem. We don't have the fear of crowding out because nobody else really is looking to borrow to expand operations. But when the economy recovers, if the government is still needing to suck up that much resources from the private sector, there is going to be a problem. And of course, we do not want to have a situation where the Fed is having to raise interest rates to fight inflation. At the same time, the government is having to raise taxes to finance a deficit. I mean, these are the kind of scenarios that I think, you know, looking out 3 to 5 years, rightfully raise a lot of concern.
Michelle Girard, Rafael Resendes, thank you both. Appreciate it.
Thank you.
And here is a look at what's still ahead today.